Hello, it's Robert Miner with Dynamic Traders Group with today's DT update and trade strategy. A couple things is going to be different about today. One, it's going to be more than our typical 5 or 6 minutes because I'm not going to be doing another video for Twitter or YouTube followers until Saturday, January 11th, and that's 3 weeks from now, taking a 3-week break from all of this activity. And so I thought I'd do what I do is I'm going to go over a lot more markets than I typically do for these abbreviated videos for Twitter and YouTube. So I'll cover them rather quickly, but I'm going to cover several of the major markets, the stock indexes and gold, silver, GDX, bonds, notes, dollar, euro, that sort of thing. We'll go through them quicker than I typically do for subscribers, but at least it'll give you an idea, at least of where I think the markets are at and what will be the best trades in the coming week or two. So let's get started with it. And of course, if you like what you hear here, you might check out our DT reports at dynamictraders.com. Very inexpensive with a lot of educational videos every week with the video updates every week and of course daily updates as well with specific trade strategies. Okay, now we'll get started. We'll start with the stock indexes, and I'm just going to focus on the ES, but what I talk about applies to all of the indexes. And for the first time in many, many weeks, even months, we have an almost ideal Elliott wave pattern position to indicate that we're at or very near a fairly significant high, at least a high that'll last several weeks, potentially even several months. So coming up from the October 3rd low, we got 1, 2, 3, 4 into the December 3rd low, and then we continued higher. And frankly, as you'll know from some past updates, I thought we had completed this top back here in late November. Well, of course we didn't. We came down and then recognized fairly quickly about 3 or 4 days after that no, the market's probably going to go higher before it goes lower. Well, look what's happened here in the last week or two. The last section up from this December 3rd low is subdividing, this is Elliott wave terms again, into an almost ideal 5-wave section. And that should be the final section up from the October 3rd low. So I want you to be aware of that, and that as of Friday, we've reached the ideal and actually exceeded slightly the ideal end of wave 5 of 5 price target. So I'm going to show you the intraday data in a minute. But again, this advance from at least the October 3rd low, and since that's it's almost a 3-month advance, we should be make a correction sideways to down for several weeks, if not even possibly 2 or 3 months. The latest, these time factors are December 24th. That's the latest to when the wave 5 of 5 should be complete. That coincides within a day or two of the winter solstice. We always want to be aware of solstices and equinoxes for whatever reason. We tend to have reversals near those dates. And another thing to be aware of is December 26th is the 1-year anniversary of the 2018 low, very significant low. Anniversary dates, you don't want to trade on them themselves, but when they coincide with other time factors, you want to be aware of them. Here's our 240-minute data, again, coming up from the December 3rd low at 1, 2, 3, 4, and then here's 5 of 5, 1, 2, 3, 4, 5 in the 240-minute data. So I did a little update for Twitter on Wednesday and showed this wave count that we were coming into a probable top, but we never signaled that the top is complete. So what we do when we get into extremes like this of a technical factors, and then we have to identify, well, what can the market do to say that this trend is over, or at least give us an indication that it's over, and we can have a specific trade strategy with a defined stop. Well, right now, certainly it closed below the December 18th low from last week. That's when it's the wave 4 of 5 of 5. But because this intraday data here in the last few days looks like it's unfolded so nicely in waves 1 through 4, just to trade below Friday's low at 3208.50 is the initial signal that the much higher time frame trend is over. So that's how we use multiple time frame analysis in all of our momentum, time, price, pattern, everything. So it wouldn't only indicate that this 5-wave advance from December 3rd is over, because when this 5-wave advance is over, it should complete the advance from the October 3rd low. So it's a really significant signal that you want to be aware of, a trade below Friday's low, and the confirmation, the strongest signal is a trade below the December 18th low at 31.92. That'll indicate this, or confirm, I should say, this section is complete, and the higher time frame trend from the October 3rd low should be complete at least. And it allows us to take action with very minimal capital exposure, whether we do short trades or, if nothing else, when we get into this a position to complete let's say a weekly trend like this, depends on your time frame of trading, is that you can certainly adjust stops on long trades, knowing that more than likely, once those signals are made, we're going to be sideways to down for several weeks, and typically we do at least a 50% correction from the December 3rd low. So that's the stock indexes coming up for the week. I want you to be aware of that this is the first time in many months that we've had just a beautiful textbook pattern with the potential to complete at least a weekly high, if not a monthly high. Well, nothing's changed in the position of gold in the past week or two, but I'm going to identify for you a specific trade strategy for the next few days. They'll probably be initiated the next few days. This is gold weekly, and in Elliott wave terms, more than likely a few weeks ago, we completed a wave 4 correction. What follows the end of a correction? Well, a continuation of the trend to a new extreme. So more than likely, gold is going to eventually this rally is going to get underway a little more definitely, and will continue to above the September high. We have many more weeks on the upside, more than likely. The weekly momentums are dual look back bullish, so and nowhere near the overbought zone, so that itself indicates we should be net bullish for several weeks. Let's take a look at the daily. What we've been recommending over the last few weeks, ever since the weekly momentums got bullish, is every time we get a daily momentum bull reversal, that's a setup for a long trade. And it was a setup back here in the middle of November, a setup here near the end of November, and it was also a setup here in early after the December 9th low. And there were great setups to add to current long positions or to initiate long positions if you weren't already long, with really, really minimal capital exposure, considering that more than likely we've completed a low and we're going to continue to go to a new high above last September's high. Well, here we are once again, as the daily momentums made dual look back bear reversals. A couple of days ago, on last Thursday anyway, it looks like, or maybe it was Friday, they actually made the reversal. We should be sideways to down for 3 or 4 days in gold, but the setup here is following the next daily momentum bull reversal. We use the DT oscillator. You might not have DT, probably don't, so use whatever momentum indicator that cycles well from overbought to oversold, and when it makes reversals for you, they're reliable then for follow-through and price actions. But the point is usually once we make a dual look-back bear reversal, we'll be sideways to down for 3 to 4 days. And when we make the next bull reversal, the daily will be in sync with the bullish weekly to continue what I believe was the beginnings of this wave 5 bull trend that'll take us to a new high. So a fantastic setup, really minimal capital exposure because we're not far from where our stop is going to be, and which would be a close below 1465.10. That's the furthest away that we need a stop in any long positions once we enter, because that's the close of the last swing low. So the gold, silver, GDX have all been giving these sort of subtle bullish signals that there's strength, underlying strength in the market, there's buying power in the market, and they're continuing to do so. So I wouldn't be surprised if we're just more or less sideways and not any kind of serious decline before the next bull reversal is made. And boy, that's going to be a setup. You want to be long these markets because your stop is going to be so close to where your entry is if you're not already long. And if you're already long, you might look at that setup as a good opportunity to maybe add to your position. Here's the GDX, basically the same position as gold. probable wave 4 right in the ideal time and price targets for the wave 4 that we identified. We do need a weekly close above 2801 to confirm this low. That hasn't been made yet. It's been essentially kind of sideways, just like gold. But boy, fantastic setup here as well. And we actually made a bull reversal by a fraction anyway on Friday. So our daily momentums were near oversold, bull reversal, and so we're in an immediate position, just like taking out a minor swing high like Thursday's high to go long on the GDX and the relatively strong underlying mining stocks as well. So be prepared for that because, again, the stop's going to be so close to the market for potential long trade to a new high above the September high. So that's what you call high risk reward. You don't need a formula. You don't need any kind of ratio. You just know that your stops, your entries around here, your stops around here, and then you have the potential to go way above here. And that's all that you need to know. So take advantage of this in the days ahead. Again, we've already made the bull reversal, so then our trigger to enter is just a trade above last Thursday's high, and then more than likely that's going to then the bull trend is going to continue for many weeks, if not many months. Well, this is the weekly euro, and I'll just talk about the euro briefly. Needless to say, it's the dollar is just the opposite. It's inverted to the trends of the euro. So our weekly momentums are bullish with only the fast line overbought, and more than likely this low about 3 weeks ago was a wave 2 or B low, and that implies that we're going to continue to advance to a new high, and that's what we're anticipating here in the weeks ahead. And as you'll see in a minute from the daily chart, we should be within just a day or two of completing the daily low, which then should reverse around and continue this bull trend. This is the minimum expectations on the upside should the euro continue to advance as anticipated. And this is the 100% alternate price projection of the wave 1 or A and the 78.6% retracement. So a ways above the market. So are we going to have a good setup? I think we're going to have a great setup here early next week. Timing wise, the 23rd, that's Monday, has two key time factors. That's the 62% time retracement and the 100% alternate time projection of this last decline. Those both come in Monday. Of course, we have the winter solstice, and the 5 to 6 trading day count, reversal count, was Friday and Monday. So more than likely, this is a corrective decline. That's how we're looking at it. And if you, from some of our prior brief updates and Twitter posts, you know that we were looking off of this high. Did one, I think, just last Monday that euro should continue for another 3 to 5 days sideways to down to complete a corrective decline. That's exactly what's happened. And we've now reached Friday. I know it was a big down day on Friday, but we're near the probable time target to complete a daily low. The daily momentum fast lines oversold, so that's warning we're within a day or two of a low. And then we just tagged the 62% retracement coming up or down from the November 29th low into the December 13th high, which was just a few pips away from the 78.6% retracement of this advance from the, December 6th low. So again, we should be a day or two from completing a corrective low in the euro, followed by a continuation of the bull trend to new high. So what a fantastic setup that's going to be once we get a reversal signal. Very minimal capital exposure once we get the reversal signal for a probable trend up to well above the December 13th high. So of course that means the dollar should be within a day or two of making a corrective high, followed by a continuation of the bear trend. And our long-term outlook for both of these markets is long-term, very bullish for many weeks, if not months, probably many months in the euro, and very bearish for many weeks or months in the dollar. Let's take a look at one more market that's a great trade setup here right now. Well, this is weekly crude, and weekly crude has hit the dual time frame weekly momentums, or dual look back, not dual time frame, are overbought. We just had this 162% external retracement of this last significant weekly decline, and that's probably the typical limits on the upside. So we should be at or near or having completed a weekly high this past week. We need to see a weekly close. It'll be next Friday's close below 60.44 to confirm that reversal and that high, but I think we're probably going to get it. Here's the trade setup, though. And what you need to be aware of if you have any positions or if you trade crude or stocks related to the trends of crude oil is that on Friday, the daily momentum's made a dual look back bear reversal. Whenever you make a daily, smaller time frame reversal in the daily momentums, when the higher time frame, in this case weekly, is overbought or bearish, that's always in a dual time frame momentum position to have completed the higher time frame, in this case a weekly high. On top of that, on Thursday's high was right near the extreme of the ideal end of wave 5 target zone. And between the 19th Thursday and Monday were the two key time factors, which would be the maximum before a daily high should be complete, and that'd be Monday. So we've made the high on the 19th itself. That was just a simple high to high count. The 23rd is a low to high count. Those are always maximum targets for a reversal. So we're in a position to have already completed this daily high, which should coincide with a weekly high. On Friday, we made what's called a three-close reversal. We closed down below the closes of the past three lows, and that's fairly significant. And so more than likely, the crude's going to be sideways to down for several weeks, reach at least the 50% retracement, if not much lower, and that's quite a ways down below where we're at right now. Reach at least the 50% retracement, if not much lower, over the next 3 to 4 weeks or so. So if you happen to be long and trading any, whether it's stocks or ETFs or crude itself, on the long side, you just bring your stops really close to the market, because if we didn't complete a weekly high last week, we're really close to it, because everything's at the extreme, and it's looking like we probably have completed it after Friday's three-close or bear reversal. So it's also in a position for a short trade or bear ETFs that go opposite direction, trending as the crude does itself. So take a look at those as well. Well, that's it for today. I hope you have fantastic holidays. Once again, I'm going to be out for about 3 weeks. Be back with you on January 11th. If you like what you learned here, pass it on. Pass it on to your friends. Let them take a look at it. And of course, if you learned something, check out our DT reports at dynamictraders.com. Take care.